Hello, my name is Aaliyah. This is James, Hannah, Quinn, and our team captain Frida. We are Team G, and today we will be presenting our equity research results with said recommendation for home builders Plough Group, also known as PHM. Plough Group is one of the largest home builders in the United States of America with financial service of adjusted rate mortgage. Their focus is built to order, which makes up about 65% of their sales, with a higher margin. The remaining 35% are spec, which are alternative models and have a lower margin. Plough Group operationals are geographically diverse. As of 2021, Plough Group operated in an average of 799 active communities within 40 markets across 28 states. Plough Group has a large, wide variety of home designs with brands like Plough Homes, Dagosta Homes, John Wyland Homes and Neighbors, Syntex, American West, and Del Webb. The home building industry is extremely competitive in the United States of America. Though Plough Group is one of the largest home builders, they only represent about 4% of the national market shares in the U.S. as of 2021. Traditionally, they represent less than 15% of home sales in the United States with both new and existing homes. Also, we will see in the SWOT and 5-force analysis that Plough Group has a very high threat of new entrants. Although Plough Group is able to compete with their competitors with a strong brand and their focus of sustainability and environmental responsibility.
For the environment, our home builder will have an ecological footprint because of all the resources needed to build home for customers. PHM take a big environmental responsibility for sustainability and they require all of the land investors to follow the environmental guidelines and regulation. Another large component to reduce the environmental impact is their awareness of energy use control. For the social, PHM invests in their employees through extended training and supporting programs to ensure the quality in the staff work for provide service for customers. They also proud themselves through their contribution to the community. In 2021, they have built 68 free homes for veterans and that's nearly $24 million. One of the big initiatives of the board is to increase the availability of affordable housing options within the market. For the governance, PHM Board of Directors has split into 4 different committees: nominating and governance, compensation and management, finance and investing, and audit. The construction market in the United States has been rising strongly in the recent years with high demand and low interest rate, which can be the big benefit for the PHM. According to the in-house research, the U.S. construction industry is expected to grow at the value of $1 trillion in 2025, and the residential construction market is forecast to grow at the rate of CAGR 44.4% and with the value of $794.3 billion in 2023. Throughout the SWOT and 5-force analysis, they have pointed out the positive for the PSM, including the strong brand, strong financial performance with low debt and better access to their labor resources, greater geographic and product diversification. In contrast, for the negative for the PSM include the rising material costs and labor, the land cost, it costs 2/3 of the total cost, the high record of the population growth at 65%, low home ownership rate, which from 1% to 0.7%, and the cost of customer awareness.
Plough Group total revenue grew at 12.9% compound annual growth rate compared to the industry average of 6%. Their gross operational net margin is better than the industry average. They're able to pay off their short-term debt, however, the ability to pay off long-term debt has been decreasing for the past 2 years. Their current ratio is comparable to the top 3 in the industry. However, the quick ratio has been is seriously lower than the top 3 in the industry with a quick ratio of 5 times. Their operational cash flow has been uptrend for the past 4 years. They have a higher net profit margin and total loss reaching lower than the industry average. meaning they're doing a good job at controlling their expenses and using their assets more efficiently. Their financial leverage of 1.34 is lower than the industry average of 1.676, meaning that they're using less than the industry average. While comparing to the top 3 home builders in terms of market cap, D.R. Horton, Lennar Corp, and VR Corporation, we observe that Pool Group has a lower return on equity than D.R. Horton and NVR due to lower return on assets. Therefore, for Pool Group to be in the top in the industry, they should improve their net profit margin and their total asset turnover. A 5-year EBITDA multiple of 4 times is generated by the base case model with a target price of 55.28. The base case model was developed using past performance and earnings growth expectations. As the housing market slows down, we expect to see a decrease in earnings and sales growth of in the next 5 years, negative 8%, negative 7, negative 3, 2, 5% respectively. We observe a similar pattern between 2007 and 2009, with sales growth being negative 35% and negative 32% in 2008 2009. However, we don't expect the upcoming downturn to be as severe, and we do expect Pool Group to be better prepared to deploy their resources to slow down cancellations. Therefore, we expect the Pool Group to match up the industry long-term industry average of 5% by 2027.
So for the future distribution to stock investor via dividend stock repurchases valuations, so we arrive at the 5-year CAGR of dividend and stock repurchases at 4%, and it's continued to grow. The cost of equity is at 13.36%, and we have the target price of stock, which is $48.53 US. So pitch and all multiple valuations, we assume the ideal multiple is affected by the industry outlook. And the industry outlook is processed by the NAHB, the National Association Home Building Index, which is based on the home builder survey. And we choose PP ratio, the price to book, because that is the only multiple would go along with the NAHB. So assuming the coming downturn is not that bad comparing to 2008 downturn, P and PP ratio will be arrived at 1.2 at the beginning of 2024. So based on the BB ratio and the subjective probability, we have the target price of $52.22 US.
For the comparable firms multiple valuation, we selected 10 companies in the same industry based on business description. And the company's revenue, EBITDA, and EBIT multiple were used. For example, we multiplied the MTM total revenue of Pulte Group to the industry MTM revenue. And then after adjustment for cash, short-term investment, and debt, we will get the implied equity value. Dividing implied equity value to the number of shares outstanding, we will get the target price. After repeating the process for possible value, then the estimated range is about $21.70 to $70.60. Our target price, $50.50, is determined by the outcomes of free cash flow valuation model using the 5-year axis, EBITDA, the dividend repurchase, own multiple, and lastly, comparable from multiple valuation with 30% weight on the first 3 and 10% weight on the comparable from multiple valuation. We obtain a 12-month target price of $50.50. For the home building business of Pulte Group in a corporation, despite some negative headwinds such as declining population, increasing interest rate, high home ownership rate, rising material and labor costs, lack of skilled labor, and customer price awareness, there's also some positive tailwinds such as strong brand and services, the PHM, new initiative for multi-family homes, and sustaining long-term demand for home. We see that most of the negative were priced in 2022 and the positive are priced in 2023. As of yesterday, the target price was $53.58. We see that there's no upside left for the next 12 months. Therefore, we issue sell recommendation. Thank you for listening for our representation. If you have any questions, please go ahead and ask us.
I think I heard a the high threat of new entrants, how materially does this impact such a large, I want to say their top 5, how does that impact?
I'm sorry.
It's this one.
I'm not there.
But you-
Do we have a stuff there?
Now, just tell me about your concerns about the threat of new entrants.
Yes, ma'am. Well, my concern with the new entrants is though they are a large home builder, because they only represent about 4% of the national market shares, I think that with the new entrants, if they are able to come in and if they are able to more efficiently provide homes at a lower rate, then consumers will essentially go ahead and buy homes from their new entrants more so than Clue Group. And then they will not, since they aren't already seeing that much of a gross profit, it will continue to decline. And since the cost of building these homes are continuously increasing, they will continue to be spending more money with seeing less profit.
Generally pretty difficult to achieve scale in an industry like this. So, but my second question is, how is this company managing the rising costs of goods? And I actually think your slide said higher demand. Are you guys forecasting higher demand or lower demand for new homes?
We forecast a higher demand for a new home.
Okay, interesting. Okay, that's perfect.
My question is, with regard to ESG factors that you looked at, is this company above their peers, relatively equal to their peers, or below their peers in terms of your overall assessment of ESG?
Okay, well, Clue Group does have a very strong brand. Can y'all go to, I'll tell y'all which slide to stop on.
Forward or backwards?
Forward. Okay, right here, back. No, next, I'm sorry.
Like backwards or
Yeah,
forward?
next to
Forward.
this slide right here.
Oh,
So Clue Group, these are some of their rankings in 2021, as of 2021. So they are number 75. Well, as of 2021, they were number 75 of the 100 best companies. They were number 54 in the Fortune Best Workplaces for Millennials in 2021. They were 47 in the Great Place to Work with Best Workplaces for Parents in 2021. They were number 3 in the People's Company That Care in 2021. Number 30 in Fortune Best Workplaces for Women in 2021, and number 7 in the Greatest Places to Work of Best Workplaces in Texas of 2021. So when it comes to Clue Group and comparisons of their competitors, I definitely think when it comes to places to work, they take very good care of their employees, which will also represent that they take very good care of their customers.
So above?
Above.
Thanks.
Can you talk to me a little bit about how they decide to allocate capital in terms of stock buyback, dividends, and commitment to paying down debt?
we were talking about this. Can you repeat that question one more time?
Can you talk to me about how they allocate capital and make decisions about stock buyback, dividend, and paying down debt?
So first and foremost, as I'll say a little bit and I'll let you pick up. You can add. So they are, as of 2021, they were able to pay off their short-term debt, but they were having a much more difficult time paying off long-term debt. They do buy back their dividend, their stocks, and they actually give them as incentives to their employees. We feel like that is because of that is one of the ways that they get their employees to stay longer. And maybe have to, and that's one of their investments into their employees, as we mentioned in the ESG. They do, Clue Group does invest in people to make sure that they are able to give adequate results to their consumers.
In terms of long-term debt, so they have a lot of expenses. So, and even though they have their operational cash flow has been high for the last, I don't know, 4 years, it's becoming more difficult as like labor is higher, materials are higher. So, I think it's more difficult for them to pay off their long-term debt.
Yeah, when I was looking at their income statement as of 2021, though they had about $13 million of revenues, about 71% of that was cost of goods sold. So they spent about $9 million to provide those homes, even though they did get revenues of $13 million to when they actually sold those homes. So they only their gross profit was about only 22%, which means I think that's why it's more difficult for them to pay off their long-term debt.
Thanks.
Just a quick question on the projection for this year in 24. I was just curious on kind of the logic of how you guys think about the decline. I guess the magnitude of the decline. Is it pricing, volume, or any other kind of commentary?
Okay. To repeat your question, you're asking how do we come up with the decline for 2024? Okay.
Which one?
I think you should go to the slide with the and we were talking about population.
Oh, that's population and growth rate.
Go to the one where we had the
Which one?
I would say go to the one when you have the percentages like in the table that you actually showed.
This no. This one? This is so growth.
No, not revenue. She's going back. Not in the appendix. It's in what
Oh,
we
this is
presented.
percent. Which one? This one?
Actually, maybe it is in sorry. 1 second. I know what slide I'm looking for.
I think it was on the slide before. Yeah, just looking at that sales growth out.
Oh, this.
Sales growth.
It's not the slide I was talking about.
No, well,
Yeah, I was talking about.
that's in the appendix though.
It is in the appendix?
It is in the appendix.
Okay. Do you have a specific question on this one? Because what I was about to explain is in the appendix. But if you have a specific question on this slide, then you can answer.
No, I was just curious on the trends of kind of the sales growth outlook. Is it kind of pricing, volume, or just how you guys
Is
think
it-
about that?
Sales growth, that's in, I think that's in volume. That's in volume.
I think he's asking where did you get the estimate?
Oh, this.
How did you come up to that conclusion?
Go to the appendix. Because we have like a 22.
This is what I.
No.
This is
No. Well,
okay.
I'm so sorry.
That's it. This is what I was on.
How we got to the sales growth. So we did EBITDA multiple rather than just the expected sales growth rate because we use an EBITDA multiple because it's more conservative and it's more reliable than just the long-term sales growth of 5%, which is the industry average. So that's how we got.
Last question.
Yes, sir.
A famous investor, I think, once said, it's great to buy when the blood is running in the streets. Is this a case when, are you saying that the downside risk is so much higher now that it's not a case of, even with the negative outlook, that it's a good time to buy or a bad time to buy? What's your?
I think if you're gonna buy, it probably in the next year or so, because we still have negative sales growth rates for the next 2 more years. So you probably are gonna receive a lower price in your stock.
And also, another reason why we are saying that is probably a better sale recommendation is because in a home builder's industry, it's really important to get people to buy your homes. And then Florida is like one of the that's one of the places that the most retired people buy homes. And we feel like right now, all of the people that are retired have probably already bought their homes with Plu Group. And since the cost of homes are so much due to inflation and et cetera, we don't feel like a lot of people will be buying homes for Plu Group right now. And that's why we have these negative growth for 2023 and I think 2024, which you were asking about, is the slide I was trying to get to. And we think that is because of the fact that people won't really be buying homes right now due to inflation and such a high cost in homes. So that's all. That's our recommendation.
Thank you.
Thank y'all.